Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview. I'm delighted today to be joined by Mr. Rory Johnston, founder of Commodity Context, based in Toronto. Rory, thanks so much for joining us.
Thanks for having me. I'm very excited to be here.
Great to have you. Well, I mean, there's a lot happening, obviously, on oil, in oil markets and outside of them, impacting oil markets. So let's start with perhaps the most recent news and kind of put that in the context of where you see the balance of oil supply and demand, sort of, let's say, for the remainder of the year. We've had, prices were sort of relatively stable in the first month of the year compared to, let's say, the average of what we saw last year with the volatility. And then we had last week, of course, this announcement by OPEC, which was supposedly a surprise to many in the market. What's your outlook for did they call it right, first of all, in your opinion? Where do you see demand for oil and the expectations around that sitting where we are today at the beginning of the second quarter?
Yeah, so I mean, obviously, both the market and OPEC ministers were very concerned about the demand outlook. I think, anyone that says that, this cut is kind of bearish, I think probably overstates the case. I do think that all else equal, this is still a bullish cut. I think, a million and a bit kind of fewer barrels in the market, tighter balances, kind of higher prices. But I do think that did come on the back of obviously kind of already at least balanced markets. So my modeling has kind of shown balanced to mildly oversupplied markets for most of the beginning of the year. And then obviously we had all of this kind of what I'm calling essentially the mini banking crisis, which seemed to kind of last all of 2.5 weeks. But that sufficiently spooked financial markets to flush a huge amount of speculative participants out of the market and brought, Brent almost kind of down, below $70. And that was obviously a very concerning kind of, psychological threshold for OPEC and OPEC plus ministers. So I do think that, that said, we did get this, as you were noting, kind of a very large kind of surprise cut to the market. And it really only brought us back to the mid-80s Brent, which is kind of more or less the midpoint of where oil had been trending year to date. So it was kind of a really, really big development, kind of, that's what was required to just get us back to where we were standing still. So obviously the market is concerned. It does seem like demand, broader global demand, definitely, I wouldn't say weak, but definitely not strong. And I think where most eyes were looking for kind of an additional kind of over and above demand impulse was China. And I think there as well, this is an area where demand is fine, but it's not gangbusters. And I think a lot of analysts, particularly, the more bullish you were, typically the more bullish you were on Chinese demand. And at least this far, it doesn't seem like those, gangbuster level demand growth expectations are kind of coming to fruition yet. So I think with that in mind, without that kind of Chinese demand, the second half of the year doesn't look, overwhelmingly strong, particularly if we don't lose any Russian supply. So, and this, this comes into this question of like, what even are these voluntary cuts in the scheme of things? Because they're not official quotas. Right? Sorry?
Yeah. Well, I mean, I was going to say, a lot of people are saying, well, actually, these voluntary cuts, and then if you add up the Russia voluntary announcement cut, that they essentially are nothing new. They're kind of almost replacing the ones announced in October by OPEC plus. So and again, that explains we're just back to $85. So realistically, if that's kind of the proof of the pudding, right? You would have thought, the markets should have crossed the $100 line if it was taking it more as additional cuts. But on that point on China demand, you raised that expectations on that. That's kind of been a bit slower to come back in the new year, as compared to what people were saying last year. And then, of course, on the other side of it, you have the Europe-US economic performance, and of course, China relies partly on that. What's the sentiment where you are in North America on where the US economy is headed for the rest of the year? I know we've got lots of financial talk now of Q1 results coming out soon, and big bad negative headlines about the US economy, but we still aren't seeing bad unemployment, etc. Inflation has not been tamed. Why are we trying to create perhaps the expectation of recession if it may not happen?
No, I completely agree, and I would say that where I'm sitting in Toronto, the view has generally been like every month it seems to be kind of a pivot. It's we're finally things are weakening, and then you're like, oh well, we get a bunch of stronger data, and it seems to be that businesses, maybe we are starting to see some weakness there. And I think that probably is beginning to be reflected in, for instance, diesel demand. And as we were talking about earlier, this was further helped by the especially warm winter and kind of sapping demand for heating oil and kind of other associated heating uses for oil. But on the overall product demand side, it seems like business might be kind of flagging a little bit, kind of diesel, freight, etc. But consumers still seem to be rip-roaring. You've got very, very strong consumer balance sheets. As you're noting, employment remains extraordinarily resilient. Wage growth seems reasonably resilient. So at this stage, that's going to lead into, we're already continuing to see strong prints on jet demand and kind of air and discretionary air travel. At the same time, we've recently seen, I think, the biggest kind of sign of this reasonably kind of stronger consumer versus weaker business side is the fact over the last kind of week or so, we've seen the prices for gasoline finally begin to peak up above diesel again for the first time since last May. And if you think about it, last year we saw those really, really, really high gasoline crack spreads, around June of last year, around the peak of driving season. And this year, where they actually seem to be stronger at this point in the season than they were last year, which is, I think, a strong point of concern for people that are watching and hoping that we don't see a replay of that. Because, while I think central banks to a degree were able to take a little bit of their eye off of the oil ball, because, there was always that discussion of, typically they get to ignore oil and energy and food prices and just focus on core inflation and kind of that trend. But given that there was so much concern last summer around this idea of an unmooring of consumer and kind of citizen inflation expectations, all of a sudden they were all watching headline inflation. They were all watching, the most visible price that we all see, which is the price of the gas pump. And even if Brent prices were only at around, let's say, 120, 130. Well, with gasoline crack spreads at $60 plus, you were actually already, consumers were actually facing effectively $200 oil already last summer. And I think if we do see a repeat of that, that's going to be a major, major source of concern for central banks, because that kind of idea of inflation expectations is going to come back onto the table again. I would say that I hope that at this stage, through the crisis, we've generally healed some of the dislocations in the refining market that really prompted the extremities of that crack spread blowout last year. But again, I think one of the lessons we've learned of the kind of pandemic era markets is that it's always these very bizarre kind of supply chain sides that kind of creep up on us, and all of a sudden it's all anyone's talking about, and no one was talking about it a month earlier. So no one knows where that next one's going to be, but I do think that if we do see kind of a similar replay, it's going to become, topic du jour of politicians and central banks once again.
Absolutely, and an election year in America as well. I mean, you mentioned supply chain, and the US shale oil industry is one sector that's having problems with that, trying to get rigs and even staff, etc. Give us your take on where you think US production is kind of almost back at its peak and it's kind of stabilized, and also Canadian new production as well, in terms of what sort of the appetite is to pour money into more production. I know in the US it's kind of stuck and people are investing in just maintaining, but give us a picture of where you think US shale production may be headed this year, and also Canadian.
Yeah, so I'll start kind of south of the border in the US. Generally, I mean, I think one of the most challenging aspects of this kind of narrative pivot that we've seen through COVID is the fact that US shale production, and particularly on the crude side, has considerably slowed. But, that is from an unprecedented historic level. And in many cases, it's still growing at, gangbusters levels by any other standard. So yes, we have seen, voluminous supply chain challenges with US shale, everything from, sand for proppant, pressure pumping capacity, which, you know, in my vantage actually seems like the completions seem to be a bigger choke point right now than the drilling. And I think above all, and kind of, you know, beyond everything else, is labor, which is just an issue that's, you know, across the economy, but particularly acute for the oil patch, given the fact that, again, this is hard work. And when supply chains are tight, you know, people, if they have the choice, you know, will do something a little easier than kind of, you know, working out in the field and on rigs like this. So I do think that those things have come together to materially slow the pace of U.S. shale growth. But again, it's still going. It's at this pace, at this stage at least, it's still growing virtually faster than everywhere else on Earth. You know, rewind to 2018, and we were growing on a total liquids basis in the U.S. so like 2 million barrels a day year on year. Faster than the rest of global demand put together, essentially forcing OPEC to cut just to balance the market and stand still. It does seem like we are past that point, which I think for the entire industry and from a view on stability is kind of a favorable development. But I think, one, people have counted out U.S. shale repeatedly over the past decade and generally been proven wrong. So I am, at this stage, kind of wary of saying, you know, siding with the claims that we will actually see peak U.S. crude production, you know, this year coming. That still seems, for me, a bit premature. But I do think that, you know, no doubt, you know, we're well past the days of million barrel a day plus crude production growth year on year, probably something more in the realm of kind of 300 to 500,000 barrels a day, which, again, much, much slower, much faster than virtually everywhere else. And then this is where I'll take that opportunity to pivot up to Canada and say that, like, even at the peak of Canadian oil sands production growth in the kind of early 2010s, Canadian production growth, which at that stage was thought of as one of the major growth centers on the planet, was only growing at about 200,000 barrels a day year on year at its peak. We are seeing kind of, and I think that right now, we're seeing a much slower pace of that growth as well. Most of that is because that pipeline, if you will, of investment that really came along from, say, mid-2000s up until the mid-2010s, we finally got that kind of final push and final development, kind of those projects coming online right up until more or less COVID and into today. That stuff's mostly through now. At this stage, all the growth is going to be in so-called kind of brownfield expansions of mostly in situ or thermal SAGD wells. There seems to be very little appetite for any large new oil sands mines. And even the one that there has been proposal, for instance, Suncor is proposed kind of expanding its legacy mine, because that's running out, in sometime in the 2030s, and as of yet has received kind of rejections from the federal government on an environmental basis to expand that. So I do think that Canadian oil sands production is slowing, no doubt, and probably going to be in that kind of 75,000 barrel to maybe 100,000 barrel a day range on a steady state kind of going forward in the next half decade. Will still be kind of one of the more stable, reliable sources of incremental growth, particularly as we get the Trans Mountain pipeline that comes online, fingers crossed, hopefully next year. And then finally, even moving away from the oil sands, the other kind of exciting new area of kind of exploration and production potential in Canada is on Canada's east coast, off the coast of Newfoundland and Labrador. And that's where the new kind of our first true deep sea project has recently been approved in Bay du Nord, which will open up a very large new kind of petroleum province. And I think that could be kind of an exciting next step for Canadian offshore, which had been reasonably steady to declining for a while now. So really between kind of in situ kind of SAGD brownfield out west and out east, kind of this new idea of ultra deep sea, and following much the same model of those kind of floating vessels with tiebacks, much like we're seeing in Guyana and Brazil.
Yeah, and of course, as you mentioned, Guyana and Brazil are another two areas where there is that sort of incremental supply that is coming, could be brought on quicker if we need it. So because there's a lot of, some people are saying the second half of the year will be, regardless of demand concerns, we could really be in a tight supply situation. Of course, OPEC can then come back in and say, well, we're increasing production, but there is some question marks over how many of them can do that anyway, in that sense. I want to talk a little bit about US sort of oil policy as well, but just to talk about Russia as well, before we're out of time. We haven't mentioned Russia. Of course, it's had the biggest impact on the oil markets in the last year, what's happening there. more impact from the fact that we have a war in Europe and everything else that's triggering, rather than actual Russian oil supply being, I suppose, lost. It's been redirected, but we haven't yet seen these sanctions really impacting the volumes coming out of Russia. What do you think that's going to continue for the remainder of the year if we assume that everything else remains the same?
I mean, so this is, the $1 trillion oil market question that last year we had, the mother of all kind of, rug pulls on the market. This time last year was roughly when the IEA released that kind of blockbuster, oil market report where they said that Russia was going to lose 3 million barrels a day of production through the latter half of the year. And we essentially lost 1 million barrels a day of production very briefly in April, and then things bounced back to pre-invasion levels pretty solidly, and they've remained more or less steady since then. So not only did we not lose 3 million barrels a day of Russian supply last year, we actually lost, at least temporarily, 2 million barrels a day of Chinese demand. So I can't think of any other moment in oil market history where you had effectively a 5 million barrel a day kind of balance reversal. So when people are talking about, oh, last year's volatility was insane, it was fundamentally justified by the movements in supply demand forecasting and balances. It was like utter craziness. But today, fast forward through multiple different rounds of sanctions, crude bans to Europe, and now kind of refined product bans, things, definitely pressure's mounting. You have these more established supply chains now and kind of experience shipping around Western sanctions, with alternative insurance providers on shadow fleets. This stuff is being worked out, but no doubt that pressure continues to mount. And even this morning, there was yet another headline from Bloomberg about how maybe this is the time that we have seen, weekly shipments out of Russia fell back quite considerably, their largest in, months. Is that going to be it? My take at this stage, and who knows, maybe this will look silly in a couple of weeks when it's confirmed, but I generally have a hard time believing that this is now really the time where the sky is actually falling. It seems like they've been extraordinarily resilient, and even if you do see kind of a reduction in seaborne shipments, there was also a story this morning about looking to ship more oil to Iran via rail. And I think that, as you get less and less visibility on these supply chains, you just leave more and more kind of in the narrative and rhetorical power of Moscow and the Kremlin. And what we've seen over the past couple of weeks has been, it's classic Russian strategy is this idea of like gaslighting and throwing, information out all over the place. And that's what we've seen. Production is level, but then Moscow comes out, I think, a couple of days ago and says, actually, we cut back 700,000 barrels a day in April. But that doesn't, no one, or in March, sorry, no one sees that information, but the market kind of takes it and it's like, wow, that's a big number. So I think that, everyone has their estimate of Russian production, and even Russia's own numbers don't line up. So I would say at this stage, no one knows. And I would say the best assumption at this stage is that there will be no change in Russian production in the near term, because that's what we've seen for the past year. And things only seem, while pressure continues to mount, they're also getting better at resisting it. And then the final thing I'll say on that is that a lot of people have included Russia in the surprise OPEC cut, which gets you to that 1.66 million barrels a day or so. But for me, it's such a fundamentally different story that, the majority of that surprise cut announced, I guess, 2 Sundays ago now was, the core of OPEC, Saudi, Kuwait, UAE, et cetera. And they've been extraordinarily disciplined around hitting quotas or commitments, whereas Russia has been all over the place. So I actually think it does a disservice to the rest of the announcement that Russia kind of tacked itself on, because it allowed the market to kind of say like, is this a real cut or is this like a Russia cut? Well, and I think that's the challenge.
That is the challenge, but who's allowing them to tag on? That is Saudi Arabia and the leading.
Absolutely.
They want Russia to tag along. They want it on to keep them on side, and they've said that. It's not just that they're showing it; they've said that. And of course, the other thing is also the West wants Russian oil to keep flowing to an extent, doesn't it? That's how they designed the sanctions. They just want to try and make Russia suffer on the revenue front one way or another. Rory, let's just, before we run out of time, let's talk a little bit about the energy transition as well, because and maybe in the guise of not so much Europe but US policy, and you can touch on Canada as well with your expertise there as well. Again, we have got the Inflation Reduction Act and all the sort of incentives there for energy transition sort of initiatives, if you like, and you've got the sort of US OPEC battle there on the US telling OPEC last year, when prices were too high, please do something to bring them down. Well, why don't you, and then everyone turned around and said, well, why don't you just increase US production, and the defense, of course, was, well, we've got our energy transition agenda. So, but the whole world has that agenda. But where do you think the US administration is today with regards to that? It's kind of backtracked a bit in terms of the restrictions it's placing on the oil industry. In this new oil world order that we've seen sort of take shape in the last year or so, has that in any way fundamentally shifted the transition agenda, if you like, in America, or is it just temporary?
It's definitely changed the tone. I think, I think we're still in the scheme of things, in the scheme of these massive policy pivots, we're still in early days here since Russia's invasion. We're a year on, but that's still, short time in policy world. But I do think that one thing we have seen is I think there's been an interesting mismatch in the human capital and the challenges that have been thrown at Western governments. That a lot of these governments, I think particularly as a great example is the Biden administration, a lot of individuals that came into that administration, particularly around the energy file, were looking to, push through the IRA, accelerate renewable deployment, et cetera, et cetera, et cetera. And instead, they found themselves kind of, defending against a generational fossil fuel energy crisis. So that's why you saw, this massive kind of pivot into discussions about the SPR and these discussions about what's happening. How can we get U.S. shale to drill faster? And I think there has been reasonable kind of befuddlement in the White House and in Treasury and the Department of Energy around what can they really do to really accelerate U.S. production? Because as the U.S. doesn't control U.S. production in the same way that, Saudi Arabia controls Aramco or even, Moscow controls Rosneft. So it's all around incentives and kind of removing barriers. But even if you removed every barrier in existence, one of the overarching narratives over the past kind of 18 plus months has been this idea of the U.S. shale patch investment discipline that, the classic example as the CEO of Pioneer was basically saying if oil hits $200, $300 a barrel, we won't invest anymore. We're just going to kind of harvest cash flow. And in that kind of scenario, it's extraordinarily difficult to imagine a policy that would tip the scales for more development. I think over the longer term, yes, less restrictions, more assistance, it's all going to move the needle. But in the immediate term, certainly not fast enough to kind of offset anything that's happening in Russia or Saudi, which is why I think the Strategic Petroleum Reserve, particularly in this new era of more active use, has become this actually interesting kind of analytical object, whereas historically it was mostly just this inert pile of crude that no one ever touched. So this new idea, and I've written a bunch about this, the idea of SPR 2.0 or this more active management strategy, I think there's actually a lot to that. Although, however, the challenge has been that the bureaucrats and the administration kind of behind it are very, very, very new at this. And there has been, a plethora of kind of execution challenges. Obviously, this idea of trying to refill the SPR, they wavered around that. That seems to have, I think, justifiably angered kind of ministers through OPEC, that they're like, wait, you were supposed to buy crude once it fell below kind of $70 WTI, and you've kind of balked. I share their annoyance. I think that the U.S. should have. And one thing I will say, I don't think the U.S. should have necessarily filled the SPR just because again, the market was still reasonably backwardated. That's actually not where you want to be refilling an SPR. But the issue is they said they were going to refill the SPR. And if you commit to it, and this whole idea of forward guidance and credibility, you essentially kind of begin to pull some of the analytical ideas around from central banks. And that's everything. The market already doesn't believe that the Biden administration is serious about support for the oil market. So when you face that kind of doubt, you need to really, really, really stick to your commitments. I'm like, if you didn't want to refill it, don't say it. Don't just assume that the prices aren't going to go back down and then you'll have to call your bluff. At this stage, we're in the situation like you really need to stick to what you're doing. And I do think I don't share views that this has fundamentally weakened U.S. energy security. I think actually the practice of using this very unique oil asset will actually, in a way, actually bolster U.S. energy security. But they need to keep using it. And they need to, use it and communicate how they're using it in good faith. And I think that has been a challenge.
Absolutely. And of course, they didn't, and the difference, of course, in the last 10 years, as you said, is that they've actually built up now significant, independent production, haven't they? Whereas in the past, SPR was a lot more critical, if you like, as a real reserve. So now it is a tool, just like Russia, just like OPEC's playing a little bit with its quotas as well.
Absolutely.
Rory Johnston, founder of Commodity Context. I'm afraid we've run out of time very quickly, but thank you so much for your insight today on the oil markets and the forecast and look ahead. Interesting times, certainly.
Thanks for having me.